Good morning. I'm Tom Bayer with Sikich, and I'm in our Indianapolis office. I'm joined by Jim Brandenburg, who is in our Milwaukee office. Thank you all for joining today. A few housekeeping items before we get started. We do encourage you to submit questions through the question feature on the webinar control panel. We'll try to get to those during the presentation. If there are too many questions, we will address them after the presentation. So encourage everyone to ask any questions. The presentation slides can be downloaded from the handout section. We also have some other handouts that we'll refer to throughout the presentation. Those can be downloaded as well. So please take a look at those, including the handout. And finally, polling questions will be launched throughout the webinar. These will need to be answered in order to receive credit for attending the presentation. We are offering CPE credit for this webinar, and at the conclusion, we'll also ask you to complete a short survey, and we'll also require that to get CPE credit. So with that, we'll go ahead and get started. Good morning, Jim.
Good morning, Tom. Thank you all for joining us here today.
So Jim and I have been talking about doing a employee retention credit webinar specifically for bankers for a few months. We thought there's some information that we wanted to make sure was provided to the banking community about employee retention credit. So today we're going to hopefully cover all of those points to give you a better flavor for the employee retention credit so that you can serve your customers better. So today we're going to talk about comparing the retention credit to the PPP loan program. We'll kind of give an overall overview of the employee retention credit, including both CARES 1 and CARES 2 employee retention credit provisions. We'll also talk about changes that came about in the American Rescue Plan, which was passed earlier this year by new President Biden. Interaction of retention credit with PPP loan. There's some important points to make there. And then just how to capture and claim the benefit for employee retention credit. And then some final thoughts about what we see as some really critical areas that our lenders and our banker friends in our various office communities should know. So with that, I'll start us off, and then we'll jump over to Jim. We'll kind of switch back and forth as we go along here. So the first thing is just to compare the employee retention credit and the PPP loan program. And I want to direct you the very bottom bullet point there. We do have a comparison chart that we put together earlier this year that compares the employee retention credit and draw 1 and draw 2 of the PPP loan in the handouts within the control panel. So take a look at that. It's a lot of information, but I think it's pretty well put together to give you an overview of those programs. But as we know, the PPP loan and the employee retention credit were both available in 2020 and 2021. The PPP loan program is ended earlier this year. The PPP loan draw 1 was capped at 10 million, and draw 2 was capped at 2 million, as we recall. But there's no cap for employee retention credit. So that is one difference. Now, the small employer in 2020, small employer was 100 employees. The max really was 500,000, right? Because it was really calculated out to be 5,000 per employee for the entire year. In 2021, the small employer limit went up to 500, all right, under the new rules, employee retention credit for 2021. And the amount was more on a quarterly basis. So the max you could get as a small employer went from 500,000 to 14 million. So large employers could possibly go higher, but we're So these limits were really only referring to small employers by definition. The PPP loan was obtained through the bank and administered by the SBA. And the employee retention credit is a refundable payroll tax credit governed by the IRS. So the benefit you get a little bit differently through a different process. PPP loan can be forgiven and no tax owed on debt relief, but the employee retention credit is treated as taxable income. Okay, so that there is a tax effect to those credit dollars that our customers receive. So again, look at that comparison chart. It's a lot of information, but I think it's a good summary. It's a good reference tool. So let's jump into sort of an overview of the employee retention credit. So it provides an incentive to employers that are impacted by COVID-19, and there's really a four-step process. Okay, there's the affiliation rules. So the first thing we have to do is determine if by attribution, by affiliation, if the customer we're dealing with, we have to combine their business because of ownership attribution rules with other businesses to determine several factors, which we'll get into later. So we have to go through these affiliation rules. We have to determine if they're eligible, right? So to be eligible, you either have a significant decline in gross receipts, or you have to determine that you had a full or partial shutdown of a business from a government order, right? So a full shutdown is fairly easy to determine because it probably relates to a non-essential business, right? During the height of the pandemic, certain businesses were forced to close by government order. They were non-essential. So those would be more of a full shutdown. The partial shutdown rules are really much more complex, and we'll get into those to some extent. But that's where a lot of businesses continue to operate or operate at a lower level or at a not a comparable level, and those are the rules. If you don't qualify under the significant decline in gross receipts, then you look to the partial shutdown rules. So again, small employer or large employer, it's different for 2020 versus 2021. 100 employees for 2020, 500 for 2021. And then in the last step is determining eligible wages, right? And there's lots of rules around that, but the main rule is that you can't double dip with PPP. As we look at wages that were reported and used for forgiveness, we can't use those same wages and health insurance benefits in the employee retention credit calculation. So, but different for 2020 versus 2021. So with that, I'm going to let Jim take us through a little more detail on some of these rules.
Okay, thank you, Tom, and thank you everyone for joining us here this morning with it. Again, as Tom mentioned, we sort of had this four-step process to work through. As Tom mentioned, again, these affiliation rules are to see if you have to aggregate your business or organization with another one. And they've got some rules for it, again, whether it's a for-profit business or even a not-for-profit that you look at. But if you do have to aggregate business, then you look at the combined business to do some of these tests here. And we're going to go through. So when you look at this full or partial suspension of operations, you're going to look at it on the combined basis, not just on a separate business. Or for the gross receipts, you got to do that gross receipts calculation. We'll go through that in more depth in a little bit. You're going to do that on a combined basis for the companies that get aggregated in there with it. For the employer, the number of employees that you have, as Tom mentioned, it's to be a small employer, it's 100 or less for 2020 or 500 or less for 2021. Again, if you have to aggregate, you would do that on an aggregate of the companies that you bring together. And then the same with the maximum credit that you can claim for an employee. Again, you're not going to get an employee that could apply for 3 companies. Maybe it's only going to be 1 for that employee. So just be aware that if you do have some related businesses, you may have to aggregate them and look at these tests on a combined basis. Okay, next, what we're looking at here is this next step, and this is really the, this is the key, I think, part of this is making this determination. Are you eligible for this retention credit that we talk about? And it's really a two-part test that gets looked at. First is you must be carrying out a trade or business, and that's just pretty standard with it. And again, what they do for, if you have a tax exempt organization, they treat that as being in a trade or business. So almost by definition, if you're a exempt org and you're doing your exempt function, you're going to be a trade or business. So that's the first part of it. So they want to get a trade or business is going to be eligible for the credit. And again, we see at the bottom, it doesn't cover any state or federal or political, any government body doesn't get this. Again, they're looking at either exempt organizations or active trades or businesses. So the second part of this test, again, where it gets a little bit more involved here, in the next slide here with it, Tom, is looking at two things, and Tom alluded to this before with it, is there's really two parts. And again, I think one is more objective, that you can calculate, determine this. And that's the first one, the significant decline in gross receipts. We'll talk about that in a moment. Or you have this full or partial suspension of operations during a quarter based on orders from an appropriate government authority that limit commerce, travel, or group meetings, again, due to COVID. Again, so that's this subjective determination that is out there, again, that you could qualify for. So again, it's one of those two tests that will help an employer determine whether they're eligible for this employee retention credit, the gross receipts or the full or partial suspension of operations. Okay, what we're going to first look at is go through, again, it's mechanical. They have some tests with it, but again, I think it's somewhat helpful to be familiar with some of these tests. And again, as Tom mentioned, is we do have different sets of rules here for 2020 and 2021. Okay, the first is for 2020, we need a significant decline. It needs to be a greater than 50% decline in gross receipts. Okay, and what you measure that in is you're really doing a quarter by quarter determination. So you look at the calendar quarter of the employer, even if it might have a different fiscal year. You look at the calendar quarter of the employer, and you're going to compare. In this case, for 2020, you're going to take each of the quarters in 2020 and compare it to 2019. And again, what they're looking at is, again, sort of post or during the pandemic and pre-pandemic, to see if you have that decline. And how it works in 2020 is when you make that comparison, once you have a greater than 50% decline in gross receipts for that quarter, then you continue to get the retention credit until you get up to the point where you're at, greater than 80% of your revenue in a quarter compared to the comparative quarter in 2019. So you could get it for a couple quarters in a row. We have some numerical examples we'll go through in a minute. Then, however, in 2021, when they extended the retention credit for 21, they have a different calculation. And in that case, what they look at is looking at the quarter in 21 compared to 2019. Again, looking back toward the pre-pandemic, the corresponding quarter. Or they have this what they call alternative quarter election, where when you look at a particular quarter, you can take your prior quarter and look at those gross receipts and compare it to that same quarter in 2019 to see if you qualify. So you really have two chances to possibly qualify in 21 with it. And again, it's only a greater than 20% reduction, which again is not as significant as a 50% one, which might make it more possible for more employers to qualify for this credit. Okay, here's a little chart here that might help with it. Again, we color coded just because of the different quarters and the different rules that you apply. On the left side of it that we're going to look at is, again, for each of the quarters in Q1 through Q4, they're looking at their wages. They're going to compare their Q1 and 21 versus 19. Okay, that's how they measure it. The same thing going down. But if you look down at the bottom of the page here, for 2021, again, you're going to look at each quarter and compare it to the same quarter in 2019, or you can use that alternative calculation I mentioned, where you look at the previous quarter. You can see in that first quarter of 2021, we can actually use Q4 of 2020 versus Q4 of 2019. And again, if you meet it in either of those, you can qualify for the retention credit for that quarter.
Yeah, one of the things I'll add here, Jim, is this important point here is that, you know, the gross receipts or the significant decline in receipts test can really be met, not necessarily because of a decline in business, but maybe simply because there was a significant sales event in a quarter in 2019 that didn't happen in 2021 that could have caused a more than 20% decline. So one of the things, you know, you should encourage all of your customers to look at their quarterly receipts or their quarterly revenue and determine and compare it to 2019. And there may be credit availability there just by chance that there was just an unusual swing that occurred.
Right. And for instance, that's you know, excellent point, Tom, with it, that when you could be down, let's say the first quarter you had, again, maybe a large order or contract that you had, and you were down 22% in the first quarter, but you know, you were up, you know, 24% in the second quarter. So for the first 6 months, you might be above where you were in comparison to 2019. However, again, once you get over that 20%, you can qualify. In effect, as you can see in the chart here, you're going to qualify for not only one quarter, but potentially for 2 quarters with it. So it's important to do that, the determination. And the other thing that when you're looking at the gross receipts, and Tom and I were talking about this before too, you look at their, whatever method they're using for tax purposes, which again, could differ from maybe what they're using on their financial statements. And again, you know, the fact that you get some fluctuations in when they recognize that actually may be to their benefit, maybe over a year period, it evens out. But if it kind of has those spikes and valleys, if you will, during the year, that may help you then qualify for one of these quarters and then be eligible for the credit. So something to be aware of as you look at that. As Tom said, chart out these quarterly gross receipts, you can make that determination. Okay, here's an example. Again, you know, we talked about that you look at the more than 50% decline with it. You know, once you get over 80% is when you stop. So this example at the bottom of the page here with it, you can see in this first example that we had a reduction of 55%, okay, in Q2 of 2020. So again, they'll be eligible for the ERC for that quarter Q2 of 2020. And that starts our clock, if you will. Then we get to Q3 here, we're at 75%. Okay, so we're still eligible for it then, even though it's not a 50% reduction, it's not above 80%, so we can qualify for Q3. And then you get to Q4, you can see we're at 81%, so we're above 80%, so we have to stop then. But when you stop, you actually include the quarter that you stop in. So in this case, this company in this example would get all 3 quarters then, because even though it didn't qualify in Q4, you get it for that quarter that you end up stopping with it. So that would be a favorable result for them. Okay, next one here in example 2 with it, the same thing. We have 55%. Then we get in Q3, we had 81%, so we're above 80%, so we stop right then. So then we get to Q4. Again, we're still at 81%. It's not a 50% reduction, so we don't get anything for Q4. So we only have 2 quarters then. The last one's kind of an anomaly here, if you will, is that they had a 55% reduction in Q2. They're up at 81% for Q3, so we stop then. So we get Q2 and 3, but then back to Q4, we're back to 55% reduction again. You know, the IRS doesn't really address that. If you had that unusual circumstance, you would think that you should be able to get it, but they really don't address if you had 2 dips like that. Separate dips, if you will, in the same year. So that's something unusual perhaps for 2020. Okay, let's look at 2021. And again, this is the one where, again, it's less of a decline, again, 20% instead of 50%, which again, I think, as Tom said, just having some volatility in your gross receipts may entitle you to get this credit here. Again, it's a 20% reduction that we need So you can see in example 4, what we have is reduction. Again, it was only, 19% we didn't qualify. We get to Q2 though, it's 21%. So we get the ERC for that. Then next quarter here, it's a 19%. There's no ERC with that one directly. But however, if we use this alternative quarter election, and again, we talk about that where you can look to the prior quarter, here's where that may help out with it. If we look back at, in our example here, Q4 of 2019 and Q4 of 2020, there's a 21% reduction. Okay, that's the prior quarter to Q1 of 2021. So even though we didn't meet it in Q1 of 21, the prior quarter, which is Q4 of 2020, did qualify. So they're eligible for the ERC in the first quarter. Then we get to the second quarter, where the actual results in the second quarter were 21%, so they get the ERC for that quarter. And then we get to Q3, again, they didn't meet it themselves for Q3, but again, if we look to the prior quarter, which was Q2, they had that 21%, they qualify there. So this, if we use this alternative quarter election here, you could see that all 3 quarters of 2021 could qualify with it, which again, we start working through some of the amounts with it. You can see that just being able to qualify for going from 1 quarter to 2 quarters could significantly increase the amount of credit that you're entitled to. Okay, we got our first poll question here that we're going to launch here in a moment here. Okay, here's the question. Do you believe you could have customers with significant declines in gross receipts in 2021 and then qualify for the employee retention credit? Just yes or no with this. Yeah, no right or wrong answers with this. Just you know, whatever your thoughts are with these here. Okay, we'll see the results here, Tom. What we've got, 85%. Okay, that's significant that we've got here with it, with our group. 15% no, so that's a significant number. But again, it is, isn't it, Tom?
Well, we really believe that there's some missed opportunity out there, and so we're trying to be very vigilant with our customers and talking to them about the rules, trying to encourage them to look at quarterly revenues and see if under one of these tests they could potentially qualify. And you know, the dollars are significant. You know, 70% of the first 10,000 of wages per quarter. You know, there are some rules related parties that may not qualify, but it's a significant credit, and it may be something that companies or nonprofits and or companies may just not be aware of. So
right.
I think it's a real opportunity.
Right, good. That's helpful. Thank you for your input on the polling question here. Here's one just to make sure that you're aware of with these gross receipts. Just wanted to let you know again, if any of you bankers or lenders are working with any tax exempt organizations, they too, as we mentioned before, are eligible for the retention credit. And the IRS did indicate, you know, how they measure gross receipts for an exempt organization. Again, they got a little different structure than a for-profit business, but they do mention rules on how they determine or are supposed to determine their gross receipts. So you can look at those rules that they provide some guidance with at the section 6033, which is for exempt organizations. One thing just to note, and it's kind of ties back in what Tom said before, this overlap between the ERC and the PPP. Tom mentioned before, and again, many of you are familiar with the PPP loan and helped a lot of your bank customers with that. And they got their PPP loan, and then later on had to go through that forgiveness application with it. And again, the way that the law was drawn up is that when they got that forgiveness with it, that forgiveness was not income to the company, especially it was not taxable income for them. And that was just part of the CARES bill, that they wanted to provide not only that liquidity and that funding in the loan, but did not want to have a resultant tax consequence to the borrower. One of the things here is that, let's say you had one of those, you got a loan forgiven, and you know, it was not taxed with it. You know, would that, however, be income for purposes of determining whether you had a decline in your gross receipts for the employee retention credit? You know, so it's kind of an overlap. You know, boy, if you had $1 million loan and you had it forgiven, you know, that might cause you not to be eligible for the employee retention credit because you had $1 million of income, even though it was non-tax. With the IRS, we put this notice here, 2021-33, this RevProc, revenue procedure, that basically said that you know, you don't have to include that gross receipts for employee retention credit, any non-taxable income that you got for the forgiveness of your PPP loan. So that's a very favorable interpretation, so that it, again, to Tom's point before, might allow some companies to get this retention credit now. And again, had they needed to include that as part of their gross receipts, they might not have qualified. But it's favorable interpretation for the IRS to say that that's not gross receipts for purposes of the retention credit. Okay, and here's just the brief definition. Again, if you do have an exempt group, you know, it just talks about, you know, what's the gross amount and what you reduce it for or do not reduce it for, as far as any of your program categories that you have for any exempt group. So I just leave that for you. If you do have ones that we have had a number of exempt organizations qualify for the retention credit here. And again, some using this gross receipts and some perhaps using the government order that Tom will talk about in a moment. But just be aware that you do have these guidelines and guidance out there for determining whether you have a significant decline in gross receipts.
Okay, thanks, Jim. So Jim covered a lot of eligibility rules, got into some of the specific rules around the significant decline in gross receipts. If you don't qualify, if your nonprofit, your trade or business doesn't qualify for the ERC under the significant decline test, then you have to look to, do they qualify under this idea of a partial or full suspension in operations tied to a government order, right? So it's a lot muddier of a test. And so we'd like to walk through some of those provisions. We also have a little handout in the control panel to try to help with that a little bit. But it's a very, and then we also put in the control panel, one of the handouts, notice 2021-20, which is 103 pages. It's really good information. It's very long. A lot of Q&A, a lot of examples, and that's really what a lot of practitioners and experts in the employee retention credit refer back to. It's really one of the major authoritative pieces that the IRS put out to help us interpret whether or not clients qualify. But government order. What's a government order? Legal interpretation, state, county, city, and other municipalities. You know, the health department could be, you know, provide a government order that would affect our businesses or our nonprofits. The government order must have more than a nominal impact. Okay, we'll talk about what that means. Could be indirect. In other words, if you have a supplier or a key vendor that is subject to a government order that impacts you adversely, your business customer adversely, the indirect impact of that could qualify the business owner for employee retention credit. So it's very facts and circumstances based, and you know, there's a lot of work to be done to document that. So I mentioned 2021-20. There's 71 FAQs. There's 103 pages if you consider the last page, which is blank. So, but it's really 102. Anyway, so it's a good authoritative piece. Key takeaways from 2021-20. What's nominal mean? We'll talk about that. What's comparable mean? And then the interaction with PPP loans. The other notice out there, 2021-23, addresses the employee retention credit changes made by the act that former President Trump passed at the end of last year. Okay, so that was issued on April 2nd of 2021. So what's the more than nominal size test for suspended operations? It's the big takeaway is the safe harbor is 10%, right? So if your quarterly revenues or hours are impacted more than 10%, so employee hours or the quarterly revenues are impacted by more than 10%, then that achieves that safe harbor. Not to say that if it's less than 10%, you wouldn't still qualify, but the IRS gave us that as a threshold that would, if you could document that threshold, then you would meet the safe harbor. So FAQ 11 talks about if non-essential businesses suspend operations, but allows essential business to continue operations. Is an essential business considered to have a full or partial suspension? The answer is maybe, right? Maybe. Give some examples there. We won't go through all those, but a lot of legalese here to go through to interpret the facts and circumstances for clients. Okay. So even if you failed the suspended operations test, you may still be considered, quote unquote, partially suspended, right? So if you can tie it back to a government order, right, the impact of your business, then you may qualify for the partial suspension rules. You know, the new test here and the more than nominal is a reduction of ability to provide goods or services, but does not include metrics like revenues or hours. So you know, factors that will not, this is specifically in 2021-20, factors that will not have a more than nominal effect on the operations, mask requirements, one-way aisles. These are specific examples in the notice that you can look at. Those are not considered to be, you know, partial suspension type, you know, threshold, that they don't necessarily meet that threshold. So you can kind of get a feel for the level of sort of detail you have to get into to determine whether or not you meet some of these standards. FAQ 17 talks about if an employer has to close its workplace, but it can remain operational for other limited purposes, is the employer considered to have a suspension of operations due to a government order, right? So it would be considered to be partially suspended if, under the facts and circumstances, if they're closed more than a nominal portion of the business and it cannot be performed remotely. One of the examples we typically see, right, is with restaurants that had to close their dining area, but they were able to do carry out, right? That generally would qualify. So a lot of, again, a lot of verbiage here to go through. We did give you a copy of this 2021-20 in your handouts if you'd like to go through that. Okay, here's another example, talks about non-essential care that a hospital was providing. The hospital stayed open clearly because it was an essential business. However, in this example, it did have a partial suspension of operations, right? This is one of the examples in the notice 2021-20. Okay, so you know, what factors should be taken into account to meet this more than nominal effect standard? We keep going back to the types of modifications, you know, limiting occupancy, social distancing, requiring services to be performed only on an appointment basis. You know, one of the things that that you'll find if you would review the notice, you know, businesses like professional services business like ours that were able to, deploy their employees on a remote basis and basically continue to work, in a comparable manner. That, the IRS has made it pretty clear that, if you can do the same job in a teleworking environment, that probably doesn't qualify for partial suspension. So even though, we're not coming into the office, but we're able to continue to work, effectively at the same level remotely, we probably don't have a partial suspension. Okay, so it's again very facts and circumstances based. If see the last bullet point. If we have to alter customer behavior, in other words, requiring masks to be worn or social distancing to occur, where they have to, only use aisles one way, they have to distance themselves while they're standing in the checkout line, that doesn't qualify. Okay, so a lot going on within these partial suspension rules. Really, this is where a lot of the firms like ours that are helping clients, there's a lot more involved in this. One of the things we do recommend clients do is seek legal counsel in some cases to make sure that their interpretation is reasonable, so that if they do apply for a significant credit, they don't face penalties later on if the IRS should audit and make a different determination. So there was specific language in the bill, the original CARES bill around the employee retention credit that said if you had a reasonable basis for your conclusions that penalties would not be assessed. So again, the dollars of credit available are significant, and we just really encourage businesses and nonprofits that do apply for the credit to do their due diligence and make sure they're taking a reasonable position on these matters. So with that, I'll turn it back over to Jim and to continue to talk about ERC eligibility.
Good, thank you, Tom. Again, that's some excellent discussion with that. Again, it gets into some of the detail, but you can see again when you try to apply for the full or partial suspension of a government order, it is very subjective. It is very facts and circumstance. And again, I think Tom's comment about getting legal counsel, I think, helped, because again, these government orders, many cases are state, local, county, and they're very particular. And to get counsel to say, yes, here was the particular order and here's how it affected your business, I think may help. And again, then taking that and apply it toward that notice we talked about, 2021-20. Next thing I'd like to explore and go through now is, again, we've talked about it before, this distinction between a small and large employer and what that does, especially as far as determining the amount of the retention credit you're eligible for. This is where you start to get into some of the mechanics of how much you may qualify for. Again, for 2020, small employer, again, is less than or equal to 100 employees. And again, that goes up to 500 employees in 21. So you can see how, and we'll go through this, when you get to 2021, not only do we have a smaller threshold, that 20% of gross receipts to qualify for the credit, but you've got businesses that go up to 500 employees that could be eligible for it. The key thing for it, I'll just jump to the bottom of this slide here first, is, again, if you're a small employer, again, less than those thresholds, then all wages paid to employees qualify for the credit, whether the employee is working or not. Okay, so what Congress did when they put this retention credit out there is to say, hey, we're going to give you this credit here. And they really looked at the bottom part for a large employer to say, we're only going to give you this credit if you pay employees for not working. Okay, for not working, we're going to give you this credit. But if they are working, there's no credit. However, if you're a small employer, we give this exception. We're going to carve out exceptions, say, hey, we're going to give a little relief for small business and say, hey, if your employees are working or not working, we're still going to give you the credit. Okay, well, again, in 2020, that was 100 employees or less for that small employer designation. But going up to 500 employees is a pretty significant sized business that you can be paying all your employees, and you have 400 employees and you're paying them all, and you could still be eligible for the credit on that with it. So And you don't have to look at change of number of employees or not, just a threshold, whether you meet that, less than 500 employees or not in 2021. What they use for that determination of whether you have those employees is, it looks back to the ACA rules for number of employees in section 4980H, and they pretty much the standard is 30 hours a week is the determination, or 130 hours in a month. So they look at the average with it, and they look at your number of employees back in 2019 for that test. The next thing I think is important with it, and we'll go down to this when we sort of get into the calculation, if you qualify for the significant decline in gross receipts, you get all the employee wages for that quarter, okay? Whereas if you fall under what Tom went through with the government order, you have that shutdown, you only look at the wages paid to those employees during the period of the shutdown. So let's say we're shut down for 7 weeks, you're only gonna look at the wages in that 7 weeks. Whereas if you meet the decline in gross receipts, you get it for the whole quarter again. So that's a little distinction here. So next slide here, Tom. Again, one thing that's it's kind of interesting, again, another favorable determination with these rules is when you measure the employees, you just look at a full-time employee, which again, more than 30 hours in a week or 130 hours in a month. Full-time equivalents kind of takes your part-time employees and turns them into full-time equivalents, what they have. And the IRS issued in this notice that in this 2021-49, which was a recent notice this last summer, that full-time equivalents, you don't have to include them. You're only looking at full-time employees. So that's a favorable determination with it. So you just need to look at the full-time employees for purposes of doing that 100 or 500 determination. However, wages paid to those part-time employees can still be factored into your determination and calculation of the employee retention credit. So again, a very favorable determination that the IRS made with that. Next slide here. Here's where we get into the actual calculation with it. Again, okay, you met your gross receipts, you're a small employer, how do we do this? For 2020, again, it's $10,000 of wages per employee per year, okay? And the credit factor is 50%. So the maximum credit for an employee is $5,000 per year in 2020. You can look at for 2021, however, it's $10,000 of wages per employee per quarter. Again, a 70% factor. So again, it's $7,000 per employee per quarter. So again, less of a threshold to qualify for the credit. Larger employers can be eligible for the credit, and the amount that you get for an employee on a per quarter basis is much higher in 2021. So you can see how this credit, is beneficial in 2020, but in 2021, it's 3-4 times potentially more beneficial with just because of the thresholds that apply in 2021. Okay, a couple other things with it. Again, you look at the actual wages you pay the employees, but you can also get any health insurance that the company or the employer provides for the employee. And that includes any amounts that not only, let's say, employer provided health care, but any amounts that are treated on a pre-tax basis, from the employees get included in there as well. Again, you can look at the actual wages plus any of these health insurance amounts to build toward the that $10,000 per quarter that you can have for them. And then the bottom one, Tom had mentioned this before, certain family members that you may have with it that would not be included within it. They do talk about that in this FAQ that we've talked about before, the IRS guidance on it. I don't want to spend any time with it now, but it can get very confusing when you look at what family members are not to count. So just be aware of that. So we've kind of looked at that, say if we have to get the detail, but just realize that there's quite a few other benefits available for the other employees. Our next polling question here. Okay, do you believe you have customers who filed for PPP loans and have wages and health insurance expenses that could be claimed for ERC purposes? Again, yes or no?
So we're coming up on, we've got 15 minutes left, Jim, and so we may have to cover some of these examples coming up on a more abbreviated basis.
Yeah, yes or no for this question here? %. Look at that. Okay. And again, I think that that's helpful. And one of the things that that shows that, thank you for your results on this here with it, is that again, initially when the PPP loan came out and was passed, it was the PPP loan or the retention credit, not both. And the legislation that passed in December said, no, you can qualify for both, and it's retroactive. So that's why we've seen an uptick in activity. A lot of these companies is that they're eligible for both of them now, where they initially were not. So that's why it's, as Tom said, something for you to look back at some of those, some of the bank customers that may have taken a PPP loan to look at the retention credit. Okay, let's go on to the next one. I'll try to, move along here a little bit with it. Again, some of the other changes that we had here recently, again, the change at the end of December just extended the retention credit through June. This American Rescue Plan extended it for the balance of 2021. We'll talk about it, subsequent change of that later, but they did make some changes with, they also added two new sort of sub parts of the retention credit, one for startup businesses and then severely distressed businesses. So just be aware of that. And the last thing that we'll talk on, we mentioned a little bit, is the IRS can audit and issue assessments on this. It used to be a 3-year statute. Over the retention credit, they're going to make that a 5-year period that they can look at audit this again. So it's important to document your gross receipts reduction, important to document your government order if you're using that, as well as your number of employees and wages. Next slide here. What I want to talk about again, and this is sort of an important part, is the interaction with this retention credit and the PPP loan. Again, many of you worked with the PPP loan. Now you're saying, hey, I got a retention credit. We can take it for both. The IRS or Congress has said that you can, but you can't take it on the same wages. Well, this IRS notice, this 2021-20 we've referred to in question 49, went through that and gave some helpful examples. There's 7 of them. We're going to go through a couple of these and try to go through quickly with it, but just be aware. In this case, a company had $100,000 PPP loan for wages. Again, it could have gotten, again, as you recall with the PPP loan, you could have at least have 60% of that PPP needed to be for payroll related and 40% could be non-payroll related. So in this situation, they just applied for the 100% all payroll. They submitted it. They could have used it for retention credit, but they got the PPP loan with it. In this case, the example 1 says they can't treat any of those wages for retention credit because, again, they used it all for PPP loan. Okay, let's go to our next example here. The same thing, but they had, in this case, a $200,000 loan. They had $250,000 of wages. They submitted their claim with $250,000 of wages with it. They had no non-payroll cost. What happened with it was the $200,000 went for the PPP, was forgiven, but they had an extra $50,000 of wages. In that case, they would allow those extra $50,000 of wages to be eligible for ERC purposes. So again, just if you have wages that are above what you could have qualified for PPP, those can fall over the retention credit. Let's go to our next example here, example 3 with it. In this case, same again, they had $200,000 and had $70,000 of eligible expenses. Okay, that they could have taken. Again, they could have gone up to $80,000, but they had $70,000 of non-payroll costs. Okay, however, this is where, again, it's important with you bankers to be aware of this. When they did their application with it, they just put they didn't put those non-payroll costs in there. So they just put in the $200,000 of payroll costs, didn't do anything with those other $70,000 of costs. In that case, they cannot treat any of those as eligible for ERC purposes because they only submitted wages for their PPP loan application and got it forgiven. And our next example here then is helpful with it. In this case, similar, but they did include those $70,000 of expenses. In that case, the IRS says, okay, $70,000, again, you could have gone to 80, but you had 70 of eligible, so we're going to get 70 of eligible. 130 was treated as payroll cost for the PPP loan forgiveness. That leaves you 70,000 of qualified wages in excess that could go for ERC purposes. Okay, so you're really going to have to be careful. Again, you can't double up, but depending on what you report for the PPP, it may give you an opportunity to then perhaps also get some retention credit. So Tom and I always talked on this. We're trying to thread the needle, if you will, with this is to, first and foremost, you want to maximize and get your PPP loan forgiveness. But then secondly, you want to get as much of the retention credit as you can as well.
Yeah, and we'll go to the next poll question here, Jim.
Okay. Okay, our next question. Do you have businesses or nonprofits that started after 2/15/20 that might qualify for the ERC as a recovery startup business? Again, that's one of the new items that came about from the American Rescue Plan here this past March. Yes or no with that? Again, that's a sort of a small subset of the retention credit that is available.
Yeah, while they're answering, just to follow up on your points there, Jim, if you have bank customers who haven't submitted their draw to application, you might advise them that potentially if they can, submit that with expenses that aren't, payroll expenses, they may actually qualify for employee retention credit and be able to, quote unquote, thread that needle, as Jim.
Right, still get their loan forgiveness, right. Here's our poll results, Tom. Here we've got 42% said yes, that they might have some startups that could qualify, and 58% said no. So
yeah,
we'll talk on that in a little bit here.
Okay.
Next one, just something just to be aware of. Again, the next point is claiming this credit. Again, it's not like the PPP loan where you had to go through the loan application and then the loan forgiveness. This is claimed as a payroll credit. It's not even on your company tax return or a partnership return or S corp or return. It's on the 941, which they file quarterly. Now, if they've already filed their 941 and they go back and say, company qualified, let's say back for Q1 of 2021, let's go back and qualify and do that, they've got to file a 941X, which is an amended payroll filing. So they'll go back and do that, and they'll actually get the refund from the IRS for that. Now, while this credit was available, they used to be able to file a Form 7200, which could actually get some of that credit sooner, but that's not going to be available anymore because of some changes that the Congress made recently on the fourth quarter of 2021 here with the retention credit. Just look at questions 50 to 58, which kind of help you with do your filings with it. And then 70 and 71, again, the importance of keeping your documentation records for at least 4 years. It's actually 5 years now for the tax due and paid for this retention credit with it. Again, there's very limited information that's filed on this 941X. You just explain that you qualified for the retention credit and here's the amount and they claim it. You don't have to fill out information related to gross receipts, the government order for wages, for the number of employees. We recommend that you document all those items, every one of those, that you have a report in case it's audited, but it's not part of the application as you had with the PPP loan. So something just to be aware of. Next one here, and again, just some things on going through and filing with it. Again, we're seeing refunds, what, Tom, maybe 3-4 months as far as the timing with getting some of those refunds.
It's probably at least 3 months.
Okay.
I did see something recently. The IRS is getting caught up on opening their mail, so maybe sooner, maybe a little less going forward.
Okay, good. Okay. Next time we've got some other developments here.
Yeah, so thank you, Jim. That was a lot of content there. I think there is opportunity that the statute or the rules did evolve to allow for PPP recipients to also get employee retention credit. And so it's just been a wave of constant change with these programs. So hopefully our slides and then the presentation Jim did make some sense to you. So some new ERC provisions here. We've got a couple slides left. We wanted to cover recovery startup businesses was part of our poll question, severely financial distressed businesses, and then just a couple comments on the infrastructure bill that was just signed by the president in the last couple of weeks. So recovery startup businesses, what does that mean? Well, it means you started your business in the pandemic, right? But it also means your average annual gross receipts have to be less than $1 million. So you measure it in the taxable year that precedes a calendar quarter for which the ERC is being measured. So there's some specifics around that. In other words, if you started your business last year, you really don't have a prior year to compare to. So you have to get into the rules on how to calculate whether you exceeded or you stayed below that $1 million threshold. It's determined on a quarterly basis, and the amount of ERC cannot be more than $50,000 per quarter. So this provision is still in effect for the Q3, and it's for Q3 and Q4 of 2021, right? So for Q3 and Q4 of 2021, if you have a business, a customer that started their business since February 15 of 2020, you may very well qualify for this credit. The rules are pretty, a lot of the rules we've talked about basically don't apply. So if you have wages, and I think what generally the theme here is with this recovery startup business, if you were willing to take the risk to start a business, a small business during this pandemic, the employee retention credit is sort of reward for you taking that risk. So it's 70% of the first 10,000 of wages for each employee in a quarter, but it's maxed out at $50,000 a quarter. Tax exempt organizations also can qualify, again, started after February 15th. So this is a big deal. We've had, for example, a franchisee that started their business, independent franchisee started their business last year, does qualify because they are still below that threshold. So think about those small business customers that might qualify here. A severely financially distressed employer is defined as an eligible employer for ERC that, based on the decline of gross receipts, their gross receipts are less than 10% of the gross receipts in a comparable quarter. So really, really severe drop in gross receipts in the quarter that's being looked at compared to 2019. So so in 2021, an employer needs a greater than 20% decline in gross receipts, but for this new category, it's a greater than 90% reduction. And so all employers that have this, regardless of the size of the employer, are treated as severely financially distressed. So that 500 employee limit doesn't apply here, okay? So finally, what are some key takeaways, right? Revisit those bank customers that participated in the loan program, the PPP loan program, and make sure your customers are aware of the employee retention credit. And first and foremost, make them run quarterly gross receipts or revenues and see if they qualify or if potentially they're impacted by a government order, if they meet those rules. Again, those rules on the partial or full suspension are much more complex, and you have to sort of navigate through those rules based on the facts and circumstances. It can be claimed on an amended payroll tax return. It's not public, right? It's privately filed. The PPP loan forgiveness is all public information because of the government program. You do have to document this. The IRS did recently come out and say they're going to start auditing these. They're going to start training their staff, some specific staff, early in 2022. And then there's an audit process that's going to occur. And so it's really important, especially as Jim said, number of employees, gross receipts. And if you're following these partial suspension rules, you really have to document how you were impacted and the government orders that applied. So, and finally, contact us or contact your advisors and talk through this, because especially on these government, these partial suspension rules, they're complex. They're very complex, and there are lots of interpretations. So do your due diligence there. And with that, I'm going to end us at exactly 10 o'clock. It was a race to the finish, but thanks so much for joining us. Jim, do you have any final thoughts you want to share?
Oh, great job, Tom, and thank you all for joining us. And again, I think it is, as you mentioned with the concluding comments, that again, I think there was so much activity a year ago that we were spending with the PPP loan, and again, didn't really consider or focus much on the retention credit because it was one or the other, and almost everyone really went the PPP route. Now going back and saying, well, now we can go back and get that retention credit, and looking back at those to say, hey, do you qualify for it? It's a different set of rules. And maybe you qualify in 2020, but especially in 2021, where the amounts are much more significant, something to explore for some of your bank customers with it. Whether they got a PPP loan or not, they might be entitled to it. And again, some significant benefits, but you just got to make sure that you followed the rules, as Tom said, whether it's a government order or the little more mechanical gross receipts test. I think it's important to do that. So again, we thank you for joining us. And again, feel free to reach out to Tom or myself with any questions with it. One item just to note for some of the bankers here, we have another webinar, in fact, a week from today. It's not just for bankers, but it might be something you might be interested in. We're going to go through LIFO inventory, which some of you bankers may have had to deal with for some of your manufacturers or distributors. We're going to cover some of the accounting and tax issues with LIFO inventory. So something to be aware of. And again, if you have any questions, we can get the invite out for you on that. So again, we wish you all well. Thank you for joining us.
And thank you. And just as a reminder, complete the survey at the end. And if you have any follow-up questions or if there are any questions we didn't get to, we'll get to those after the session is ended. We'll respond to you through email. And CBE credit certificates will be sent via email in the next 2 to 3 weeks. So thank you. Have a wonderful holiday season, and as Jim mentioned, look forward to seeing you maybe at the LIFO webinar. I think that's on December 9th. So thanks so much.
Thank you. Bye-bye.